Right now, oil is at $110 a barrel. The Strait of Hormuz is effectively closed. Tehran is burning, and silver just dropped. Let that sit for a moment. The biggest energy crisis since 1973 is unfolding in real time, and the one asset that is supposed to scream higher during exactly this scenario is going the wrong direction. If you watched yesterday's video, you already know the setup. Today, I am going to show you exactly why this is happening, what the institutions are actually doing behind the paper selling, and why the last two times silver behaved exactly like this. What followed was one of the most explosive moves in precious metals history. Subscribe right now because what I am about to walk you through is not being discussed on any mainstream financial channel, and by the time they catch up, the move will already be underway. Let me set the scene with real numbers because this contradiction needs to be precise. As of this morning, Brent crude is trading above $103 per barrel. West Texas Intermediate pushed past 101. Oil just posted what is on track for one of the largest single-day jumps in history. The Strait of Hormuz, through which roughly 20% of the world's daily oil supply transits, has effectively been shut down. Tanker traffic has collapsed. Qatar declared force majeure on gas contracts. Iraq and Kuwait are shutting in production. Goldman Sachs estimates a $14 per barrel risk premium is now baked into oil prices and warns that if Hormuz stays closed for 4 weeks, the impact could be far more severe. This is the definition of a supply shock. Now here is where it gets strange. Gold closed Friday around $5,100. This morning, gold futures opened at $5,095, down over 1% from Friday. Silver is trading around $84, flat to slightly lower on the week. Think about that. The biggest oil shock since Russia invaded Ukraine, active military strikes on Iranian oil infrastructure, a war economy being openly declared by the President of the United States, and gold and silver are flat to down. This makes no sense on the surface, but under the surface, the data tells a completely different story, and that is what we need to dig into, because the answer changes everything about how you should be positioned right now. Here is the first thing you need to understand. Oil up does not automatically mean metals up, not immediately, and this is where most precious metals channels get it wrong. In the short term, a massive oil spike does three things that temporarily hurt gold and silver. First, it triggers a margin call cascade across risk assets. When oil explodes higher, leveraged positions across equities, crypto, and even commodities get liquidated. Traders need cash fast, and the most liquid assets on the planet, the ones that can be sold instantly with deep order books, are gold and silver exchange-traded funds. They do not sell gold because they are bearish on gold. They sell gold because gold is the only thing they can sell fast enough to meet the margin call. Second, an oil shock raises inflation expectations, which makes the Federal Reserve less likely to cut interest rates, and the bond market knows this. The 10-year Treasury yield is sitting around 4%, real yields at 1.74%. That is the opportunity cost of holding a non-yielding asset like gold. When the market prices out rate cuts because oil-driven inflation just got worse, that is a headwind for metals, at least on the paper side. Third, and this is the one nobody talks about, the dollar index tends to spike during the initial phase of an energy crisis. Why? Because oil is priced in dollars. Every importing nation on the planet, China, India, Japan, South Korea, the entire European Union, must acquire dollars to buy oil. When oil rips higher, dollar demand rips higher, and when the dollar goes up, paper gold and paper silver go down. That is the mechanical reality. It does not mean the thesis is broken. It means the machine is doing exactly what it is designed to do in the first 48 to 72 hours of a supply shock. That is the short term. Now let me show you what is happening underneath the paper price, because this is where the entire picture changes. Let me say that again so it sinks in. The Spider Gold Trust, GLD, just recorded a single day outflow of 2.9 $1 billion on March 4th, the largest withdrawal since 2016. In the past 7 days alone, $4.2 billion has left GLD, roughly 25 tons of gold, pulled out of the world's largest gold ETF in 1 week. Now, here is the question nobody in the mainstream is asking. Who is selling? And more importantly, why are they selling at near all-time high gold prices during an active war? The answer is not that institutions are bearish on gold. The answer is that institutions are using gold as an ATM machine. This is forced liquidation. This is margin calls being covered. This is the exact same pattern we saw during the initial phase of the COVID crash in March 2020, when gold dropped 9% in 3 days before rallying 60% over the following 18 months. This is what happened in 2008, when gold sold off 15% during the Lehman collapse before tripling over the next 3 years. When paper sellers cannot move the physical price down despite record selling pressure, the structure underneath is not fragile. It is anchored, and that is exactly what we are seeing right now. Gold is still above $5,100, with that volume of selling hitting the tape. Physical gold in China is holding firm. Gold ETFs in India saw the equivalent of $560 million in inflows in February alone, taking net growth so far in 2026 to almost $20 billion. Drop hold in the comments right now if you are not selling your physical metal during this paper shakeout. Let me see how many strong hands are in this community. Now let me show you why silver specifically is the most interesting setup in this entire picture. Silver spot is at roughly $84. Shanghai is pricing physical silver with a premium that has been consistently above Western spot, reflecting real demand for actual metal in the East. Meanwhile, COMEX registered silver inventory sits at approximately 86 million ounces, and here is the number that should keep every paper shorter up at night. On first notice day for the March contract, 10,526 contracts stood for delivery. That represents 52.63 million ounces of silver, demanded against 86 million ounces of registered inventory. More than 60% of the entire deliverable supply was demanded on day one of the delivery cycle. Let me say that again. More than 60%, and this is not happening in a vacuum. February 2026 delivered 5,036 contracts, the highest February delivery volume in modern COMEX history. January saw a delivery rush so aggressive that JP Morgan issued 99% of the delivery warrants on a single day. The COMEX Stress Index, which measures coverage ratio, inventory trend, paper leverage, and vault outflows on a scale of 0 to 100, currently sits at 81. The all-time high is 88. We are in historically unprecedented territory for physical supply pressure on the exchange. The 30-day registered inventory outflow is 22.3 million ounces. The 30-day total inventory outflow is 56.6 million ounces. At the current withdrawal pace, one data tracker estimates approximately 80 trading days until depletion. That is roughly 4 months. Now think about what this means. The paper market says 84. The physical market says higher. The vaults say draining. The delivery data says record demand. And simultaneously, 3 of the largest alternative asset managers, BlackRock, Blackstone, and Blue Owl, are all blocking or limiting redemptions from their private credit funds in the same window. Doors are closing across the financial system, and when doors close in paper markets, capital eventually finds its way to the one market that cannot block redemptions, physical metal. You either have it or you do not. There is no gate. There is no 5% cap. There is no waiting period. That is the fundamental difference between paper wealth and physical reality. Here is where it gets really interesting. Comment your realistic silver price target for this cycle because I want to see where this community stands. Now let me walk you through the historical pattern that makes the current setup so significant. There have been exactly 2 prior instances where oil spiked sharply while silver simultaneously sold off or went flat despite bullish fundamentals. The first was October 1973 during the Arab oil embargo. Oil quadrupled. Silver initially dropped as margin calls forced liquidations across commodities. Within 6 months, silver began one of the most aggressive rallies in its history, running from roughly $3 to over $6 by 1974, and eventually to nearly $50 by 1980. The second was September 2008, during the Lehman Brothers collapse. Oil was still elevated from the summer spike. Silver crashed from $19 to below $9 in weeks as the entire financial system deleveraged. Within 3 years, silver ran from that $9 low to nearly $50. In both cases, the pattern was identical. Energy shock triggers forced liquidation across all asset classes. Paper, gold, and silver sell off as institutions raise cash. Physical demand quietly accelerates underneath the paper selling. Once the forced selling exhausts itself, metals catch the bid from the energy shock with a lag of weeks to months. And the move that follows is not incremental, it is explosive. Let me be honest with you. Based on the historical pattern, my analysis suggests we may be in the early innings of that exact lag phase right now. Oil has shocked higher, paper has sold, physical demand is accelerating, the vault drains have not slowed, and the catalyst calendar this week is loaded. CPI data drops Wednesday. Let that sink in for a moment. Inflation data dropping into an active oil supply shock. Oil above $100 per barrel. Gasoline prices in the United States already above $3.45 per gallon and climbing. If CPI prints hot, the market will price out any remaining hope for Federal Reserve rate cuts before summer. That is negative for paper metals in the immediate term. But here is the paradox. A hot CPI print simultaneously validates the entire thesis of precious metals as an inflation hedge. It forces the mainstream financial media to start talking about stagflation. It forces pension funds and institutional allocators to revisit their precious metals allocation, which for most sits below 1%. And it creates exactly the kind of macro panic that drives physical buying into overdrive. Smash that like button right now if you understand why this CPI print on Wednesday might be the single most important data point for silver this entire year. And here is the data point that connects everything. The gold to silver ratio currently sits around 61 to 1. Historically, the ratio has ranged from 15 to 1 all the way to 100 to 1. During the 1970s bull run, it compressed to roughly 17 to 1. During the 2011 peak, it reached around 32 to 1. Right now at 61 to 1. Silver remains significantly undervalued relative to gold by historical standards. If gold holds above 5,000 and the ratio compresses even to 50 to 1, that puts silver above $100. If it compresses to 40 to 1, which is still conservative by historical bull market standards, silver reaches $127. And if we see the kind of ratio compression that accompanied the 1973 to 1980 bull run, the math points to levels that most people are not even willing to say out loud. This is not speculation, this is mathematics. The ratio, the supply deficit, the vault drains, the delivery demand, the industrial consumption for solar and electronics that is consuming over 1 billion ounces annually against roughly 830 million ounces of mine production. These numbers do not lie. Now I need to present both sides because that is what separates data analysis from cheerleading. The risk case is real. Paper markets still dominate short-term price discovery. A ceasefire announcement, a diplomatic breakthrough with Iran, a surprise Federal Reserve statement, or a coordinated algorithmic sell-off can flush silver fast. Physical tightness means nothing to an algo running a stop hunt. Higher oil can genuinely hurt industrial demand if it tips economies into recession, and silver has meaningful industrial exposure. A global slowdown would hit silver harder than gold because of that industrial component. CPI on Wednesday, GDP, PCE, and JOLTS all hitting Friday. Any one of those prints landing wrong hands paper sellers exactly the window they need. Respect that. Trade with position sizing that lets you survive the short term to capture the long term. But here is what I keep coming back to. Three of the largest private credit funds are blocking exits. Crypto lost over 190 billion in 3 days. The S&P, Nasdaq, and Dow all closed lower. 900 billion wiped from US equities in a single session. And through all of that, gold is still above $5,100. Silver is still above 80. The vaults are still draining. The physical premiums in Shanghai are still elevated. The delivery demand at COMEX is still at record levels. The paper price is being held down by forced selling from a margin call cascade, not by bearish fundamentals. And forced selling, by definition, has a finite lifespan. When it exhausts, the spring that has been compressed finally releases. Every reference cited in this video is in the description below. Verify everything. COMEX reports are updated daily and publicly available. The GLD outflow data is on the fund's public filings. The Goldman Sachs oil research is on their website. The ones who check primary sources do not need to take my word for any of it. There are three types of people watching this video right now. The first type sees oil at 110 and silver flat and panics. They think the thesis is broken. They are considering selling at the worst possible time. The second type is confused. They know something does not add up, but they cannot connect the dots between forced paper liquidation and physical market reality. And the third type understands exactly what is happening. They have seen this pattern before. They know that margin call cascades create the deepest buying opportunities. They know that when paper sellers exhaust themselves against a structurally tight physical market, what follows is not a slow grind. It is an explosion. Which type are you? Tell me in the comments. If this video changed how you see the silver and gold market right now, share it with one person who needs to hear this. Hit the like button, subscribe if you have not already, and turn on the notification bell, because the next 48 hours with CPI data dropping into an oil shock, into a war economy, into record COMEX delivery demand, could produce some of the most important price action of the entire year. This is not financial advice. I am sharing what the data shows, and every individual must assess their own circumstances, risk tolerance, and investment objectives, but the data is the data. And right now, the data is screaming one thing. Physical reality always wins. The only question is not if. The question is when. Invest with logic, not hype.